I'm going to show you how I create and review the management accounts across all of my businesses to give me absolute clarity on boosting profits and, when it comes time to sell, how to get the best maximum possible price. Stick around to the end and I'll give you instructions to give to your accountant so they can do it the right way. I'm Dan Bradbury. I completed my first 7-figure exit in my 20s, and since then I bought, sold or merged over a dozen different companies, and in that time I've looked at a lot of management accounts. There are 3 critical management scorecards that you need to be dialed in at all times, and they are the P&L, the balance sheet, and the statement of cash flow. If you have all 3 of these management accounts, you're in the top 10% of businesses in the UK in terms of financial clarity. If you're doing them the right way that I'm about to show you, you are a 1%. Let's go through each one. I'll show you how to do it the right way and also what instructions to give your accountant so they can get on and do it easily. Getting this right will give your business a boost and it will raise its valuation and in turn increase your net worth. So let's start with the P&L. So the P&L, statement of profit and loss, tells you 3 things. It tells you the revenue, or also known as the sales or the turnover, i.e. that's the sales that you produce and bring in. It'll tell you your expenses, that's your costs, your purchases, sometimes subcategories like COGS, but expenses, costs, purchases, that's the stuff that goes out. And then it'll tell you your profit, hopefully, or if you're not doing too well, your loss. So let's look at a quick example. This is Jensen's lemonade stand, the P&L. So you can see that you've got 2 years, multiple years side by side. And last year he had £579 in total sales. And this year he's got £1,157. And that comes from lemonade and cookie sales. Then he's got a few different expenses. He's got rent, he's got ingredients, he's got his payroll. And that adds up to £414 last year, £476 this year. And therefore, that leaves him with a profit of £165 last year and £681 this year. Simple, basic example, but really a full company's P&L could be millions of pounds, but it's just got more line items, more categories of revenue or expenses, and that nets down to the bottom line. Now, that's pretty basic stuff. Most business owners are knowledgeable about the P&L, but it's the next 2 scorecards where people are entirely ignorant and it ends up costing them a lot of money. So let's cover the balance sheet and the statement of cash flow next. So at its root, the balance sheet only tells you 3 things. Accounts make it complicated and do lots of different things, but there's really only 3 core things that you need to understand. Firstly, your assets. That's things and stuff that the business has. So it could be cash, it could be receivables, it could be stock, it could be vehicles, it could be buildings, it could be tools, things and stuff, assets. The second category is the liabilities. That's stuff that you owe. It could be taxes payable, it could be loans or loans payable, or it could be a trade debts or trade creditors. So that's stuff that you owe that you're going to need to pay off. And the third category is equity. Sometimes labeled as net assets, and that's effectively what you own. So it's the net of the assets less the liabilities. So here's Jensen's lemonade stand, simple example. So he's got cash, he's got some ingredients that he used to make the cookies and the lemonade. He's got cups and a dispenser to hold the cups, and he's got the stand, right? And he needs those things in order to sell the products. That's the assets. On the liability side, he has some loans. So he took a loan from his dad and from one of his grandparents in order to get things started. And he also might have rent and he might have a bit of payroll that he's owed, but he's not yet paid. Okay, great. Well, if you have assets of 530 and you've got liabilities of 220, you're going to have equity of 310. So with that said, let's get on to the third scorecard. It's the least known and the most underappreciated. That's the statement of cash flow. And arguably it's the most valuable because turnover is vanity, profit is sanity, and cash flow is king. The statement of cash flow tells you where your cash comes from. In other words, how the business is funded and what it's used for. Is the business just scraping by, or is it producing excess cash, which can either be dividended out or used to buy more assets? And again, there are 3 areas to cash flow, 3 different types of cash flow. They're all very different. Number 1, operating cash flow. This is money that comes from customers and goes out to pay expenses. That's operating cash flow in and out. The second is investing cash flow. So this comes in when you sell off assets, equipment or a building or a vehicle. And obviously the opposite is true. When you buy an asset, you have negative investing cash flow. Cash goes out to buy those assets. They show up on your balance sheet. And third, financing cash flow. So it's positive when you borrow money. You take a loan, for example. And it goes down when you repay the capital, you repay the principal, you pay the loan off, you clear the debt. That's financing cash flow. Here's the point. Not all cash flow is equal. So you've got three types of cash flow, but operating cash flow is the holy grail. It's the mother lode. It's the major thing. Because if a business doesn't produce enough surplus operating cash flow, if it's negative, it needs to make ends meet by either selling off its assets, which is finite, or by borrowing money. And neither of those are sustainable long term. So operating cash flow is what you need. Turnover into profit, into operating cash flow. So here's the example from Jensen's lemonade stand. You can see on operating cash flow, it comes in from the lemonade and the cookie sales, and it goes out to pay the rent and the ingredients and the payroll. Right? That's pretty straightforward. But look at the other two. The investing cash flow was kind of investment that was needed as the business got started up and as it expanded. More equipment was needed as a business expands. So a business can make operating profit, operating cash flow, but that needs to be used to reinvest to grow the business. And finally, financing cash flow. So it's positive because money has been borrowed, but then it is negative when that money is paid back. And eventually all debt needs to be paid back. Otherwise, they're going to force you to and the business will fail. So a business can be making money, but still be overall net cash flow can be negative. Why? Because it can be generating operating cash flow, but if it's got to constantly reinvest in equipment and its debt load is too high, that can use up all the business's cash and it can fail. It can be insolvent. Now, here's the overall point. There's these three scorecards. Which is most important? That's a little bit like saying, what's more important? Your heart, your brain, or your lungs? They're all critical and they work together. So they're all essential for different reasons. And if something goes wrong with one of them, it won't be too long before it screws up the whole business. So you need to be dialed in on all three. Now we've got an overview and a basic understanding. That's the beginning point. There are 8 critical mistakes that you can make in your preparation of these scorecards, inside your management accounts, that could be really screwing you up badly. And worse, it could turn a simple audit into a waking nightmare. And we're going to talk about what those 8 mistakes are and how to fix them in the next video. So make sure you like and subscribe. Finally, earlier in this video, I promised you instructions for your accountant to make this really easy. So I've made a PDF that goes with this video so you can download that, send it to your accountant. So I hope you enjoyed this video. It's part of the series about how to value and exit your business. The first video in the series was about how to get it valued in the first place. So go here to watch that.